If only half of the impacted property investors decide to exit property, we could be talking about almost $2 trillion looking for a new home. Just last week, Vas and I were sitting in this very room discussing the potential impact of the budget on both the economy and on equities. Now, for us, it's less interesting to lament about whether the changes are good or bad, and far more interesting to ask, can we find an advantage? Now, we think the biggest question investors should be asking themselves right now isn't whether the proposed changes to negative gearing on property are right or wrong, it's where will the money flow to next and how can I profit from it? I don't think most people realise just how big the residential property market in Australia actually is. The Australian Bureau of Statistics estimates in a recent study that the market is worth over $12.7 trillion. And thanks to an equally recent macro business study, we know that about 27% of that is owned by investors. That's potentially $3.4 trillion of property investments that will be impacted by the proposed tax changes. And look, it makes sense to invest in residential property. For decades, property investors have enjoyed two significant and powerful tailwinds. Number one, the tax advantages of negative gearing, and number two, the long-term capital appreciation of their property values. But if those incentives change, so does the investment equation. And if residential property is no longer as attractive as it was, where is that capital going to flow? Now, some might suggest the simple answer is commercial property, but commercial property isn't a like-for-like substitute. Commercial property is far more complex, and the cost of a single property can be well beyond many investors' capacities. There's also additional risks, the risk of extended vacancy. And of course, commercial property hasn't historically generated the sorts of capital growth that residential investors have come to expect. Looking at Cotality's Home Value Index, we see that residential property was up around 9% nationally this year, and almost 6.5% per annum over the last 30 years. Once you add back about 2% per annum for rentals, that's a very solid 8.5% per annum total return. Commercial property, though, is different. It's a much more diversified investment class, and it's also much more focused on yield. Speak to anyone trying to sell an office space or a retail space over the last 5 years, and it becomes obvious that in many pockets of the commercial sector, there just hasn't been much growth at all, and in some, it's even gone backwards. While commercial property is interesting, it isn't an obvious solution for investors looking for an alternative to investing in homes. Okay, what about private credit and private markets? Well, they also come with some challenges. Investors give up liquidity, valuations are less transparent, and capital can often be tied up for years. And while it's true that private assets have delivered excellent returns over some periods, they're certainly not immune to economic cycles or blow-ups. There are plenty of examples of private credit and mortgage funds finding themselves in trouble. Recently, Blue Owl and KKR were two well-known funds that were covered by the press that took big markdowns on loans and froze redemptions. According to Reuters, Blue Owl recently wrote down $1.4 billion, writing off about half of the value of a significant portion of their assets all at once. So, for investors looking for a simple and transparent solution, private markets are probably just a little bit too complicated and risky. All right, what about equities? Well, stripping away the emotion from daily headlines, equities have actually been a great solution for investors looking to invest capital incrementally in accessible and liquid markets. Transaction costs are small and investors can diversify easily. You can genuinely build a diversified portfolio of productive assets without having to worry about all of the challenges of troubling tenants, maintenance costs, insurance claims, council rates, and body corporates, and more. As the current budget stands, investors who borrow to invest in shares can still offset the interest costs against their income. Some might call that negative gearing. Now, over the last 30 years, the Australian share market has delivered almost 10% per annum. Around 4.5% of that comes by way of fully franked dividends, and the other 5.5% has come through capital growth. That's actually slightly stronger than residential property, making shares a potentially attractive alternative for investors who've been driven out of the property market by the proposed new legislation. And if investing large sums of capital into the share market seems a bit too daunting, there are always managed funds that will do the research and stock selection for you. Now, obviously, we don't expect every dollar leaving property to flow into equities, but even a moderate increase in demand for shares could meaningfully impact equity markets and prices. But to gauge the scope and potential of what I'm talking about, I remind you that the ABS values the Australian property market at 12.7 trillion. About 27% or 3.5 trillion is owned by investors. The entire Australian Stock Exchange is valued at just 2.2 trillion. If only half of the impacted property investors decide to exit property and move into shares, we could be talking about almost $2 trillion looking for a new home. That would be an 80 to 90% increase in demand for shares. That would mean greater participation, potentially much more price discovery, and theoretically significantly higher share prices. That's good news for all equity investors, but especially the mid-cap and small-cap sectors, which would most benefit from increased capital flows and from price discovery. So what are my two takeaways? Number one, rather than focusing on the injustice of changing rules for property investors, our job as investors is to find advantage in the disruption. And number two, if just a small percentage of capital invested in property finds its way into equities, the impact could be extraordinary. Now, there's obviously still a lot of water to flow under the bridge for this budget, but while everyone else tries to fix problems, we think that value investors should be looking for how to profit from the change. I hope that you found value into these insights from myself and Vas. If you have a topic that you'd like us to consider for a future video, please do reach out to us via email or in the comment section below. Bye for now.